Hi everyone, welcome to today's webinar, Invest Like a Pro and Learn How to Create Passive Income. My name is Radhika Bhachu and we're just going to wait for a minute or so for a few people to join and we can get started. So in the meantime, just wait, relax, and I'm going to go on mute. Thank you. Right, so we have given everybody some time to join. I'd just like to run through some housekeepings. Feel free at any point to ask any questions in the chat. Just because we get lots of questions, I'll look to answer them at the end of the session, and I really hope you enjoy it. So let's get started. So hi everyone, again, thank you for joining the webinar to really learn how to invest like a pro. And the key thing of when it comes to investing, it's really great to understand how you can create passive income by making some smart investments so that you can ease the workload or the financial load that you have on a monthly basis. And so I'm really excited to take you through this. So my name is Radhika Bhachu and I'm the CEO and co-founder of Ndovu. My personal journey is that I'm Kenyan born and raised, and I've spent 15 years working in London in asset management. So I spent my time speaking to clients at BlackRock. So these are family offices, institutions, individuals, and speaking to them about how they can take their hard-earned money, invest it, so that they can make more money out of it. And when I moved back to Kenya, I realized that there was a big gap in the market. And so we then brought to life Ndovu. Ndovu's been in business for over 200, over 2.5 years, and we serve over 40,000 customers today. So I'm super excited to be here. We've helped so many individuals, and I'm sure you'll find this webinar super insightful. Great. So today, the key takeaways for this session really is for us to provide you with a step-by-step guide on how to create passive income. So I want to set the scene. Passive income is something that I wish we were taught about when we were at school, but like most life skills, we don't get told how to budget. We don't get told how to, when you start earning money, how to manage it. And if from personal view, I think earning money is very easy, but actually managing it and making it grow is the harder part. So today I want to empower you by giving you the steps and guides on how exactly to take your hard-earned money, invest it so it creates passive income, so it can allow you to be financially free. Some of the great examples that I use passive income for is, for example, for paying for my children's school fees. So I've invested some money, it generates passive income, and then it pays for school fees. And I think that's a great way to lessen the financial burden that you might have as a couple or an individual. And it's just smart, right? You're taking the money that you have, investing it so you can actually make additional income. So the key things that we're going to talk about today is what is the importance of a diversified portfolio, how to build a diversified portfolio to generate passive income, and then what type of funds are there that you can use in order to do this. So let's get started. So the importance of passive income and the reason it's important to have a diversified portfolio that generates passive income is because of this one thing known as the cost of living. So since the pandemic, especially in Kenya, we've seen the cost of living has gone up significantly, and there are usually several factors that contribute to that. So firstly, it's inflation. Naturally, African countries have high rates of inflation. The average inflation rate in Kenya is about 7%, but other African countries experience significant inflation, sometimes in the double digits. And what that simply means is that your 1,000 shillings that you have today will not buy you the same things next year. So let's take an example. If I had 1,000 shillings today, it will buy me 5 bananas, but in a year's time, because of inflation, it will only buy me 4 bananas. So your money sitting in a bank is actually doing nothing because it's being eaten away by this thing called inflation. The second reason why things have become more expensive is because of the natural dynamics of the economy, known as supply and demand. The prices of items or goods and services go up and down depending on supply and demand. And so therefore, if there's high demand for a particular product, so let's say the Apple iPhone is in big high demand, the price of that will go up. And then there are times where the prices of things go up because there's a shortage of items. For example, if there's any imported products and they're limited, suppliers or distributors feel they can increase prices, and therefore we see the impact of increasing prices. The second thing is the cost of doing business. Some of you might be entrepreneurs on the call. We've been in business, and recently with the new regime in place, taxes are going up. The cost of delivering a product is going up. And as a result of that, it forces businesses to increase the cost of their products. And therefore, we as the consumers bear the cost. And overall, we find that goods and services are becoming really expensive, and actually living in Nairobi has become more expensive. And so this is a really good way to put what I've just taught you into practice. Did you know that over the last 5 years, the price of oil has increased 230 times? And you know that oil goes into everything: distribution, manufacturing, cooking, etc. And as a result of that, it's driven prices up. So this is why you will, over the 5 years, experience an increase in pricing of the cost of living. The second reason why it's important to look at how to diversify your portfolio is because of currency depreciation. Now, recently, we've seen significant changes in currency. We've seen our currency weaken, we've seen it strengthen, and right now we're going through a strengthening period. However, what I want to look at currency depreciation is actually over a 5-year period, because longer term, it's really good to see how our currency has depreciated. This is important because as an African country, as Kenyans, we tend to import more than we export. So as a consumer, you and I, if you're a female, you'll probably use a lot of imported skincare products, clothing, makeup, etc. As a man, you might like imported whiskey. And this is why currency depreciation is something that we should look at. Now, the currency for Kenya has depreciated on average 31% over the 5-year period. So this means that if 5 years ago, if I wanted to go and buy the Apple iPhone, it would cost me $600. But today, that $600 would mean I would need to put from my pocket 31% more Kenyan shillings in order to buy the same iPhone. So currency depreciation is known as the silent thief in our firm. We always say that you need to consider currency depreciation, and we'll teach you how you can do that by investing in asset classes or funds that are denominated in USD. So what can you really do? Now, this is a really interesting key takeaway here. So there's 6 steps that you can do in order to manage your finances. This is how you actually create a financial plan. But today, because the purpose of this investment is, this webinar, is to really focus on how to create a diversified portfolio that generates income, I'm not going to go through steps 1 to 4, but really focus on step 5. And the idea really is that actually Ndovu offers a financial planning advisory session. So I would recommend signing up, and you'll see the link later on. And so you can walk through with an advisor on how to budget and expense, reduce your debt, build an emergency fund, diversify, invest wisely so you can diversify your investments. And as a result of that, you increase your income. So today I'll very much focus on step 5. So let's get into it. So I've told you the importance of creating a diversified portfolio. Why do we have to do it? Because of all these factors that are out of our control. And the reality is that we want to increase our income. So how do you do that? So in order to do that, there's different ways of diversifying your assets. The first thing that you could do is actually do it by holding different investment types. So typically what Kenyans are very much familiar with is like the money market fund, the infrastructure bond, and some stocks are listed on the Nairobi Securities Exchange, such as SAFCOM, BAT, and the likes. And in order for you to hold a balanced portfolio, it is good to have a bit of investments in each of these different things. So it's great to hold money market funds, it's great to hold bonds, and most importantly, it's great to hold equity funds, because the equity market is a very good reflection of where we think the global economy is going. So if we feel that, so the best way I would describe the stock market is a progression of the human race. So if we feel that companies will continue manufacturing, distributing, innovating, and we as the population will continue consuming, we expect the stock market to always grow in value. And the reality is that our populations are increasing. We are actually seeing an increase in income across asset class, across income streams. So with technology, somebody who lives in Kibera can now start a business. And that means that they move from a low income to a middle income bracket, allowing them to consume more, which therefore means that we expect the stock prices of companies to increase because they're now serving a larger and wider population. So equities is a very important part of the investment portfolio in order to generate income. Another way that you can diversify your portfolio is by investing in different currencies. So what I mean by that is we're already earning Kenya shillings. We know that earning in Kenya shillings has some risks, which means currency depreciation. And I'm not saying that it's not great to hold your investments in Kenya shillings, but we do have a range of investments that do really well in Kenya shillings, but our equity markets are not as liquid and exciting as the US. And so we always say that if you, at Ndovu, if you're looking to build a diversified portfolio, let's hold 50% of your wealth in Kenya shillings and 50% of your wealth in USD, because what that allows you to do is A, combat currency depreciation, but also if we are all a global citizen who consumes a lot of products that are priced in USD, it's always great to earn some income in USD. So diversification comes in different forms as well. There's geographical diversification, investment style diversification. But today, just to keep this webinar super simple, I'm only looking at asset class diversification and currency diversification. Because to be honest, after my 15 years of work experience at BlackRock, the reality is that if you nail these two sets of diversification, you actually have a very strong portfolio. And then you can leave the fund manager to do the rest of the diversification, which is geographical. That means investing in different countries and like, so it's better for us to keep it simple. And that is to focus simply on asset class and currency diversification. Great. So now I'm going to take you step by step. So I hope you have your pens and papers ready and you're taking notes. But now I'm going to take you through a step-by-step guide of how we can start building that diversification. So as part of the financial planning session that if you, and when you sign up to our financial advisor, they'll teach you some of these concepts, but I thought this was really important and I didn't want to just jump into investing. And here I wanted to bring your attention to the fact that you should not let money sit in a bank. And the reason really is on the screen. So here what I've done is I've taken the time to explain how somebody's 100,000 shillings would grow in a bank versus if you put it in a money market fund. So Ndovu is launching their money market fund. It's a very exciting fund. And I want to show you how it would compare in comparison to holding your money in a bank. Now, as a financial advisor, when I speak to clients and they say 100% of their wealth is in the bank, it always scares me because when your money sits in a bank, its value is being eroded by inflation. So why is that the case? So I mentioned earlier that Kenya has an inflation of 7%. So if today, let's take Sharon as example, she put in 100,000 shillings in her bank account and she's earning an interest rate of 4.2%. That means at the end of that year, her 100,000 shillings would have grown to 104,200 shillings. And on top of that, she has to pay withholding tax. So at the end of the day, at the end of the year, sorry, her money stands at 103,570 Kenya shillings. So that's after earning 4.2%. And keeping in mind that your money in a bank is being eroded by 7% inflation. So actually your money is now worth less than you actually put it in. However, if you made a simple decision of investing in a money market fund, which is a safe capital preservation asset, this is on average likely to return 13 to 15%. So after 1 year, your 100,000 shillings would be 115,000 shillings. And after paying tax, it's now worth 112 and 750,000 shillings. So just making smart choices about not just leaving your money in the bank and investing in something that acts like a bank account because it's secure, it's low risk. A money market fund is secure, low risk, and it allows you to grow your money and outpace inflation. So it's not promising you great high returns, but that's the idea of diversifying your investment portfolios, to have different investments that give you different amounts of money based on the risk they're running. So money market is seen as low risk, and it's giving you capital preservation. And you can see it's a smart decision to actually move your money from a bank account into a money market fund so that you're actually outpacing inflation. Otherwise, if your money's sitting in a bank account, you might as well spend it. So the key step first is to say, okay, if I have a portfolio that I'm looking at, let's move the non-liquid cash that I need. So not your daily, monthly expenses. Let's move a proportion of it to a money market fund. Now, the second interesting way to build and diversify your portfolio is at looking at bonds. So the first one is a cash fund, which is a money market fund. That's one asset class. The second asset class is a bond. Bond, simply put, is an example of borrowing from the government. So here I've shown you how to, this diagram shows you how you can create passive income by investing in the government bond. And simply put, a bond is, in the example of the government will say, okay, Kenyans, we are going to borrow 100 million shillings from the government, from the people, and we will borrow it for 18 years. After the 18 years, we will return your money. But as a result of borrowing your money, we are going to pay you an interest. And they pay this interest twice a year. So we'll take an example. In 2018, the government raised some money and they said, we will pay you 12.5% every single year for 18 years. And on the 18th year, we'll also return your money plus the interest. So the reason bonds are really a great way to diversify your portfolio is because bonds are seen as low to medium risk. So if you look at different asset classes that we have cash, bonds, and equities. Cash are safe products like the money market fund. Bonds are low to medium risk. And then equities are seen as more risky assets. So here we're saying, okay, in order to create a balanced portfolio, we now have our cash fund. We're now also going to create a bond ladder that generates passive income. So how would you do that? So we know that every year the government releases a Kenyan infrastructure bond. So this are all the Kenyan infrastructure bonds that have been released since 2018. And this is how they have been returning in terms of return. So let's take the example that I, in 2018, put in 1 million shillings. And as a result of that, I'm now earning 62,500 twice a year, because this bond promises to pay off 12.5%. And every year, every time there's been a bond offering, I've invested 1 million shillings. So let's take 2021. I put in another 1 million shillings. And every year now in March and September, I'm getting 63,000 roughly every single month. So, and then now let's take the latest, which is the not this year, but the June 2022. I was earning, because I invested 1 million shilling, I'm earning 68,000 shillings every June and December. So you can see that if you had participated in each of these bonds that are available, every single month on average, you would be getting about 60,000 shillings. So January, February, March, April, May, June, July, August, September, October, November, December. So this means that every single month, as a result of me having invested 1 million shillings into each of these bond offerings, I get an additional 60,000 shillings in my account so that I can sustain my lifestyle. So let's say I have to pay rent, it can subsidize some of my rent. So this is free money that you've earned by making a simple decision of investing in bonds, or you can actually reinvest this money. On Ndovu, we let you earn the money into your Ndovu pocket, and then you can reinvest it into ETFs. So you don't necessarily have to use it, but what this is showing you is that you've actually created passive income as a result of being very smart with your money. Let's say towards the end of the year, you want to take an incredible holiday. You can save your 3 months interest and book somewhere for December and actually enjoy it from your hard-earned money. So you're not actually spending your hard-earned money, you're actually enjoying the interest that your hard-earned money is giving you. And these rates are much better than fixed deposit rates you'd get at a bank in Kenya. And most importantly, the beauty of an infrastructure bond is that it's tax-free. So at a fixed deposit at a bank, you'd be charged 15% withholding tax on the interest, but here you don't pay any tax. So whatever you are earning in interest goes back into your pocket. So again, I think as part of building your diversified portfolio, having asset class diversification by holding bonds is great. But in addition to this, this actually generates passive income that you can use to sustain or support your lifestyle. So I think this is a really great slide. I hope you've taken notes. Ndovu does offer the infrastructure bond releases. Also, once you sign up and when we have some available bond allocation, so from time to time, we will say that we have somebody selling out of a 2022 bond, and you can actually be part of it and you can create your bond ladder. And this is a very simple, risk-free way of generating passive income. Right, so now we've talked about diversifying our portfolio. So the money market fund is an asset class diversification and it holds Kenya shillings. The bond is an asset class diversification and the currency is Kenya shillings. But right now, if we were to leave our investment portfolio where it is, we don't have any currency diversification. And what is the key thing that we deal with on a regular basis is currency depreciation. So in order to mitigate or navigate currency depreciation, this is why it's important for us to invest in global markets. Now, I mentioned across the spectrum that equities are seen as high risk, but the way we have looked at offering equities is through a very responsible way, which is through a fund. So what you see here is we are not asking you to do active investing, which is Radhika telling you how to go out there and buy Apple shares, Tesla shares, Microsoft, Pfizer shares. We don't promote active investing. We actually promote long-term passive investing, because if I look back 100 years, the people who have done active investing, which is buying individual stocks, versus passive investing, which is buying a sector, and I'll come back into it 1 minute and explain what that is. The people who have done passive, boring, simple investing has outperformed the individuals who had done active investing. And therefore, from my years of experience, I always recommend, let's not make it funky. If you want to make it funky, you can, but let's keep it simple and invest in passive investing. So what is fund investing? What is ETF investing? So first of all, I would like you to not be afraid of the acronyms that we have. ETFs are known as exchange traded funds, and they're very similar to a unit trust. The beauty of an ETF is just a better version of a unit trust, which you might be familiar with in Kenya. And essentially, it's a better version. So think of an iPhone 4 versus an iPhone 10. ETFs are cheaper in price, they're better, they're transparent, they're easily tradable, and they're tax efficient. And that's why we have opted to offer you a global ETFs rather than unit trusts. And what is an ETF? So in short, an ETF is a basket of securities that allow you to diversify your portfolio and allow you to grow your money responsibly and steadily over time. So for example, I'm going to take the technology ETF. Instead of Radhika telling you, go buy Tesla because it's a tech company and I think it's going to do really well, I would say, why don't we buy the sector? Because when you buy Tesla, you put all your eggs in one basket. And let's say on the day that you needed your money, Elon Musk tweeted something crazy and the stock price fell, you would be selling it at a loss. But if you simply invest in the technology sector, that fund will have 300 of the tech companies in there. And on the day that Elon tweeted something crazy, all the other companies would the assumption is they'd be performing well. And therefore, you don't see the downside of that particular one investment because it averages out and it's a diversified portfolio of stocks. Therefore, we always recommend investing in funds because being the regular general public, we don't have insider information to say that companies such as Apple will be around for 25 years, but we can say that the technology sector will be around for 25 years. So it reduces your risk. And the beauty of the ETFs is that they are in USD. So not only are you earning returns, strong returns, responsible growth over time, but you're also protecting yourself from currency depreciation. So if I was today to recommend a fund to you of where you should invest and how you should put your money, the first fund that comes to mind is the Technology Fund. Now, the reason this comes to mind is because all of us consume their products. We all use Microsoft. As you can see here, these are some of the companies that are held in the Technology Fund. We all use MasterCard, Salesforce, Visa, Apple, PayPal, and the likes, and there are many more in there that we all consume, Samsung, HP, and the likes. Now, the reason the Technology Fund is super interesting to hold is because if you had invested $10,000 on the 1st of January, 2023, your money, your $10,000 would have grown by 52%. I'm going to say that again. If you had invested in the Technology Fund a year ago on 1st of January, 2023, in a year's time, your $10,000 would have grown by 52%. That's incredible. And you're not taking risks because you're not putting all your eggs in one company. You're actually putting your eggs in many companies. And as a result of that, you will experience steady growth. Another really interesting fund is the Microchip Fund. Now, the Microchip Fund, the reason why I think this is a super interesting space is because, let's face it, as a novice investor, so someone who's a first-time investor, doesn't know how to invest, you can sit comfortably and say that in 15 to 20 to 30 years' time, technology is going to be around. The speed of innovation, we've seen it over the last 10 years has been significant. Now, in order for us to use any technology or smart devices or any tech-based components, the underlying raw material required to create smart goods and services is a semiconductor, which is also known as a microchip. So the Microchip Fund for me is something that I definitely hold in my personal portfolio. And this fund has performed 73%. So if you had invested $10,000 at the beginning of 1st of January, your money would have grown by 73% on the dollar. And not only that, you're also earning from the fact that you're protecting your wealth from currency depreciation. So if the Kenya shilling weakens, the USD goes higher, when you come back to convert your money, you're actually also protecting your wealth from depreciation. So companies such as Nvidia and Intel and many more are in this fund. But this is one of the funds that I think is something that we should continue to hold as part of our investment portfolio. Right, so I would like to just run through why investing in ETFs is better than actually holding your money in the bank. And I'm going to take a very simple example. So let's say 5 years ago, and the reason I'm bringing a 5-year example here is because I'd like you to start thinking about investments more in a long term. Sure, you can invest in a 1-year period, 2-year period, 3-year period, but actually the real value from investing comes from holding your portfolio for a long period of time. So you need to train yourselves to not care about what happens in the short term. Markets go up and down. That's the function of it. That's what it's designed to do. But we need to train ourselves that when you see your portfolio going negative, you don't have a panic and you don't sell. Because what we need to remember is why we invested in the first place, which is to say that we believe that the market will continue to grow. And investing is a good indication of human progress. And we know our companies are going to continue innovating and creating more value. So let me say that there is Sharon who decides to go to work really hard, and she's become very good at saving, and she starts putting money into her bank account 5 years ago. So she's able to save 500,000 shillings. Now, on average, she's earning 3% a year on her money that's sitting in the bank. And over the 5-year period, we've also experienced currency depreciation, which means she's lost 31% because the Kenyan shilling has lost its value against the dollar. So at the end of 5 years, Sharon's 500,000 shillings is now worth 400,000 shillings. So as a result of her not doing anything, just thinking she's doing the right thing, which a lot of us are doing, and I speak to clients all the time, they're like, I've become really good at saving and my money's in the bank. And actually, you think you're doing the right thing, but actually you're not, because your money is now worth less. I haven't even included inflation here. I've just looked at currency depreciation. So here, Sharon thinks she's doing the right thing, but really she's actually losing money. So her money is now, her 500,000 shillings that she's worked really, really hard to save is worth 400,000 shillings. Now, let's just say that Sharon had discovered Ndovu 5 years ago, and she said, okay, I have 500,000 shillings, and based on Radhika's recommendation, I'm going to invest in the Techie Fund. Now, if you had invested in the Techie Fund 5 years ago, every single year, your money would have grown by 24%. And guess what? We've diversified our portfolio in currency. So that means she's also protecting herself from currency depreciation. So not only did she earn 24% year on year, she's also protected her wealth by 31 shillings. That same 500,000 shillings, as a result of her not topping up, not doing anything else, is now worth 2 million shillings. And this is why this is such an eye-opener, is because I wish we were empowered at school to be taught how to manage money well. But guess what? It's never too late. We're now at this position. Her, by simply making a decision of investing 500,000 shillings in a technology fund, which we know and believe that technology is going to be around for a long period of time, she's actually grown her money by 2 million shillings. That's 1.5 million shillings more than what she would have earned if she just left it in the bank. It actually makes you feel a little silly. Like, I wish I had known this information earlier, so that if I'm working really hard, I could achieve financial freedom much faster. Imagine what you could do with 2 million shillings. There's a lot you could do. So my recommendation is that when it comes to investing, start small, start now. If you're still unsure about investing, I would urge you to actually book a session with our financial advisors, and they will take you through this tool that I'm just about to show you. So let me actually move to this tool, which I think is a very insightful tool in order to show you how our funds have done over time. So I'm going to run you through one more example. So I gave you the example of the technology fund, but I also spoke about the microchip fund. So again, 5 years ago, let's say I invested 1 million shillings into the microchip fund. So on the day, of course, we would convert. So the way it works is that Radhika would go online, click on microchip, say, okay, I want to invest 1 million shillings. I'd say, great, I want to do that via bank transfer. I go to my bank portal, transfer the money following the instructions on the screen at Ndovu, and I would have invested 1 million shillings. Now, because we're taking your Kenya shillings and investing them in US dollar fund, we convert your Kenya shillings to a US dollar. And as a result of that, on the day we use a conversion rate, my 1 million shillings was converted to $10,000, as give or take. Ndovu does have a fee, of course. Our fee ranges from 4.5 to 3.5%. And after the fees being deducted, we actually invest in 9,600 dollars for you. Okay, great. Now, fast forward 5 years. As a result of Radhika not putting even an additional dollar, not even one more dollar, I've just put in the money and let it sit. My account and how much it would be worth would be $38,500. So $39,000 as a result of simply investing $10,000. So it really is a no-brainer, right? And the beauty is that when you not only have I earned from the return, remember, I've also protected myself from the currency depreciation. So that $38,000, let's say now I want to go and sell my investment portfolio so I can buy a home, the house that I've dreamed of for all my life. When I come back to convert it, I get an additional 6.2 million shillings as a result of it. So that is super, super exciting, super insightful to say, hey, if I just diversify my portfolio by asset class and by currency, I'm actually winning on all fronts. So what our financial advisors do is they can really help you on a call, put in whatever you would like, how much you're ready to invest, whether that's 50,000 shillings, 100,000 shillings, 150,000 shillings, and they can show you how your money would have grown for using historical performance. Now, historical performance is not a direct competitor or direct stipulation of what's going to happen in the future, but it gives you a really good idea of what your investments are going to do. So what I would do today is if you're still unsure after this webinar on how to get started, book a financial advisory call with one of our team members, and they can do this on a personalized basis. They'll try and understand what your financial goals are, how much money you have, how best you can save more money to invest, and help you get started on your financial journey. So I'm going to go back here, and I'm going to just say that as a result of attending this webinar, financial advisors cost a lot of money, but today we are giving you the opportunity to sign up to a free financial planning session, which normally costs $4,000. You know, my time itself, when I do personal financial advisories, I charge quite a lot of money. And the value that we're giving you here is that we're empowering you to actually get started. And the reason we are doing this is because we believe that we can make an impact in your lives. So if you want to get started with 100,000 shillings, sign up today onto the platform, start investing in the Technology Fund and the Microchip Fund, split the allocation, 50,000 shillings in Techie, 50,000 shillings in Microchip, and in a year's time, you will be thanking us that we've helped you grow your wealth well. And here's a customer testimonial I would like to share with you. So we have a wonderful client called Violet Asiko. She has been with us since the beginning of our journey at Ndovu. And this is what she says. She goes, what drew me to choose Ndovu is the customer service responsiveness. The platform is easy to use. I like that as I can easily track my performance of each asset in my portfolio. Since I started using Ndovu, I've become more confident, and I would recommend Ndovu to anyone who's looking to grow their capital gains. Now, Violet was actually one of the early adopters on our platform. She's been with us through the journey, and her portfolio has grown significantly. And what I love about what she says here is that she's become a confident investor. She never used to be an investor before. She was a first-time investor. And what we provide you is we give you guidance along the way. So when you're making financial decisions, you know that you've got someone to answer your questions. We're responsive, and we do this because we do believe that investing can be daunting. And in order to get started, you do need a little bit of hand-holding, hence why we're actually giving you financial advisory sessions that are worth $4,000 for absolutely free. Great. So everyone does ask me, when you started Ndovu, what was your vision and why did you start in Ndovu? And really, what surprised me the most when I moved back from London was that we're all Kenyans. You know, we're working really hard. We go to work, we make a lot of money. But why is it that in Kenya, a Kenyan sitting in Kenya cannot invest in global markets? And the vision for me is to empower you to save and invest in your family future. And one of the most rewarding success points would be somebody taps me on the shoulder 3-4 years down the line and say, hey, because of you, I could send my kids to university because I started investing early and I actually was able to save enough for them to attend Harvard or Yale or any university of the matter abroad. But that really is our vision here. We are regulated by the Capital Markets Authority. So everything we do is in the best interest of our clients. And we make sure that your money is kept safe at all times. Yeah, sorry, I skipped ahead. And in summary, what I would like to say is don't leave your money sitting in a bank. That is the worst thing I can hear. Please make the decision to put that in a money market fund. Secondly, investing is actually a necessity. Given the cost of living going up and our salaries not increasing, you need to be smarter with your money. And that means you need to invest. And today I've given you 2 simple tips. Start off with the Technology Fund and the Microchip. And lastly, there's no such thing as investing now. The every day that you save is, or every day that you don't invest is money left on the table. So my recommendation is that get started with a small amount, but get started, because the more you participate in investing, you'll see the value of it and you'll continue putting more in. So lastly, the most important thing about diversifying and creating passive portfolio is that you need to invest in different types of asset classes and investments that have different currencies. Keep it simple and you'll see your wealth grow. Thank you very much. Now I'm going to pause. I know I've spoken a lot and we can actually go through quick Q&As. So I hope you guys have been putting some questions in the chat, but thank you so much. And I'm going to pause there.